Investors are swooping into the housing market in the fall of 2021, making cash offers and buying up homes out from under the noses of regular Americans. And this is the unfortunate reality of the housing market here in 2021. We're already in a massive bubble. Home prices are already super high. Home price appreciation is at all-time highs. And yet, on top of that, we have a massive deluge of investors stimulating the housing market, including institutional players like Zillow and Blackrock, as well as mom and pop investors who are coming in with cash and boxing out people like you, regular Americans who just simply want to buy their first home. In this video, I'm going to give you guys the cold hard data on this reality. And we're going to look over the last 20 years at investor home buying demand in the US so you can see just how bad it's getting today. And we're also going to look at the cities where it's worse, because there's actually some cities, get ready for this, where 1 out of every 4 homes is being bought by an investor right now in 2021. These are the cities where you need to be concerned if you're a home buyer that you're going to be competing with a cash offer from Zillow when you go to buy your home. We're also going to analyze the end game here, folks, and ask the question, just how long can these investors stimulate the housing market? And are we actually going to see a brutal housing crash as a result of this surge in investor demand? You're going to want to stick around for the answer to that question. So without further ado, let's get into the data. And you guys can see here that in the second quarter of 2021, we are at an all-time high in terms of investor home purchases. This is according to data that comes from Redfin, who crunched the numbers over the last 20 years, quarter by quarter, analyzed the number of US homes purchased by investors. And we are at an all-time high here in the second quarter of 2021. What's interesting is that the previous peak in investor home buying demand occurred in 05-06, as you can see here, right before the last housing bubble. We then had a housing crash, investor demand declined, and then it's been growing incrementally since then, all the way through 2018, 2019. There was a slight dip in the second quarter of 2020 due to COVID, but now we're back in the second quarter of 2021, the most recent data, to all-time highs. Companies like Zillow, BlackRock, Opendoor, mom and pop investors coming in, buying up homes in the US housing market. And what type of homes are these investors buying? They're buying lower priced homes. The red line on this graph, which shows that in the second quarter of 2021, real estate investors bought over 20% of lower priced homes in America compared to only 13 or 14% of higher priced or mid-tier homes. And this is important to realize. Investors aren't buying expensive homes. By and large, they come in, buy homes that are around $200,000, $300,000, $400,000, and they buy them in cash, which is super problematic for many Americans during a housing bubble, because it's those affordable homes which are most in need for middle-class families in the US who are looking to buy their first home. Unfortunately, those affordable homes are getting snatched up left and right by real estate investors who often pay cash. According to the same Redfin data, 75% of these investor purchases are in cash, which is a huge advantage for these investors when they come into the housing market, because the regular American, they have to go through the traditional process of applying for a loan, which takes time, there's mortgage contingencies. While these investors, whether they be Zillow or a mom and pop investor, they come in, have a cash offer, can buy the home right away. And what's really concerning me is that this investor influence on the US housing market is at an all-time high right now. Like if we go back to this graph, you can see 21% of all low-priced homes purchased by investors. Even in the previous housing bubble 05-06, that number was only around 12%. So we are really in a new paradigm as far as investors coming in and influencing prices, inventory, and demand in the US housing market. Now, the thing to understand is that this isn't happening everywhere across the US equally. Simply put, there are some cities where there's a huge surge in investor demand, lots of investors buying homes, and there's other cities where it's not really happening. And it's very important to understand these differences so you, as a potential home buyer, can know the odds of you having to face competition from a big company like Zillow coming in and making a cash offer when you are trying to go buy a home. So let's take a look at this data on a city-by-city basis so you can see the areas where you need to be most concerned about investor home buyers. And that's what we're looking at on this graph, where each bar here represents a different city and the percentage of homes in this city that were purchased by investors in the second quarter of 2021. This data also comes from Redfin, and it shows that on average in America, 15% of all homes were purchased by investors in the second quarter of 2021. It was 21% for low-priced homes, 15% for all homes, but there's significant variation around this average. If we go kind of to these lower bars on the left, places like Providence, Rhode Island, Warren, Michigan, New Brunswick, New Jersey, Pittsburgh, PA, Seattle, Washington, Minneapolis, Chicago. These areas have a fairly low share of investor home purchases, less than 10%. And you can see that most of these areas are kind of in the Midwest, whether they be Chicago, Minneapolis, Pittsburgh, Warren, Michigan, Providence. A lot of Midwest, Northeast, Rust Belt areas don't have as much investor interest. Now, as we go up the chain here to like 15% range, which is average, we have West Palm Beach, Columbus, Ohio, Riverside, California, Fort Lauderdale are around kind of the average in America, 15% of all homes being purchased by investors. But really what we want to focus on here are these red bars all the way to the right, where almost 25%, 1 out of every 4 homes in these red bar cities are purchased by investors. If you guys are enjoying the data I'm providing to you in this video and you want to see more of it going forward, just make sure to hit the like button. When you guys do that, it allows me to produce more of this content going forward and uncover more about what companies like Zillow and Blackrock are doing to the US housing market. So if you want to see more of this, hit the like button. What are these cities? Charlotte, North Carolina, Jacksonville, Florida, Las Vegas, Nevada, Atlanta, Georgia, Miami, Florida, and the leader, Phoenix, Arizona. These are the places where investors are just coming in like a freight train. And that's kind of crazy, guys. 1 out of every 4 homes in a place like Phoenix, Vegas, or Charlotte is getting purchased by an investor. That is absolutely massive, especially when you consider that like the difference between a robust, strong housing market and a weak housing market can be as much as a difference of 10% in demand either way. To have 25% of the demand coming from investors really shows you how much these investors are influencing the housing markets in these primarily Sun Belt markets, which historically have always had a lot of investor demand, always been somewhat volatile as a result. And I think an interesting question to ask yourself is, what is the inevitable long-term result of this investor demand? Like in the short term, we know that these investors are coming in and they're making prices more expensive for locals and they're basically boxing out regular homeowners in the short term. But what's going to happen in the long term in these markets? That's a very interesting thing to think about, because I don't think a lot of people properly understand what investor demand truly means for a housing market, and how, in fact, the more investors you have in a market, the more likely it is that you are going to have a housing crash going forward. Let me show you what I'm talking about. And to think about this, I want you to put yourself in the shoes of a regular homeowner in, say, Phoenix or Vegas or Jacksonville, right? And say you purchased a home in 2021 for $450,000, and this is a home for you and your family to live in, right? You want to live in this home. Now, I want you to imagine that you as a homeowner, you purchased this home in 2021, but then unfortunately in the next year in 2022, the local housing market declines by 10%, and your home that was worth $450,000 is only worth $405,000 now. Now, the question to ask is, what do I do next as this homeowner? Do I freak out because the value of my home declined by 10% and immediately sell my home before prices go down by even more? Or do I just continue living in the home with my family and continue making mortgage payments so long as I have my job? I'm going to continue making mortgage payments. Most homeowners, I suspect, would select option B. Yeah, it sucks that the value of my home went down by 10%, but I primarily bought my home as a place to live. So even though my equity is down and I'm not feeling good about the fact that my net worth is down a little bit because of the reduction in home value, it's okay. This is a place for me to live, and so long as I can afford the mortgage payments, I'm not going to rush to sell if prices decline. Now, that's the mentality of a typical homeowner. What about the mentality of a real estate investor? Say a real estate investor in Phoenix, Jacksonville, or Charlotte. What are they thinking in the same situation? Now put yourself in the shoes of an investor whose primary goal of buying a home is to make profit. Now imagine it's basically the same situation. You purchased the home for $450,000 in 2021. The value declines by 10% in 2022. Now, what do you do next if you're the investor? Do you sell the home immediately before prices go down further, or do you continue holding through the downturn and or rent it out for cash flow? And while different investors are going to have different answers to that question depending on their personal situation, you're going to have way more investors answering option A, sell the home before prices go down further, than you are regular homeowners. But simply put, investors are not fundamental demand. They don't live in the home. The home is purely a speculative profit maximization tool for an investor. So if they sense that their profit is declining and could decline more, aka prices are going down, investors are going to be heavily incentivized to list their homes for sale. And that is why markets with a high share of investor demand are riskier than markets with a low share of investor demand. The more investors that are piling in when things are getting good, the more investors that are piling in and pushing prices up in the upturn, the more that will then sell in the downturn. And it's no secret, it's no accident that it's markets like Phoenix, Vegas, Miami, and Jacksonville, which are historically volatile, have historically had high price growth and did big price crashes. It's not an accident that these are the ones that investors are in, because it's the presence of these investors that ensures this volatility. Now, I suspect some of you might be saying, Nick, hey, wait a minute. I kind of get the argument you're making, but an investor doesn't have to sell if prices go down. Like, they could rent out the property and get cash flow from a renter and just pocket that cash flow and hold through the downturn. And yes, that's correct. A lot of investors out there do love cash flow and they're buying for cash flow. Except there's one problem right now in the housing market of 2021, and that's that cash flow is basically non-existent. With how high prices have gone up right now, the rental yields and income yields of investment properties are very low today in the fall of 2021. So if you're an investor buying now, if you're an investor who bought in the last year, you're going to really struggle to get any type of meaningful cash flow, particularly in these growing Sunbelt markets. And you can see that evidenced on this graph where we're comparing a handful of cities and a statistic that I call rental yield over the last 7 years. And all this is taking two data points from Zillow. The first is the typical annual rent in the market as reported by Zillow and dividing it by the typical annual home price. And this gives you the rental yield, how much rental revenue cash flow an investor can expect to get in different markets. And you can see here this yellow line is Miami. So in August 2021, the typical rental yield in Miami based on annual rent of $26,000 and a typical home price of $364,000 is 7.2%. Now, this is one of the higher ones of all the markets we have here, but the thing to understand is that this rental yield in Miami has been going down consistently over the last 7 years. 7 years ago, it was 8.7%, meaning that a real estate investor in Miami in 2014, 2015, 2016 was getting a much higher yield on their investment than they are today. And this downward trend in rental yield is evident across pretty much every market in America over the last half decade. This red line is Dallas, Texas. 7 years ago, the rental yield was 8.3%. Now it's 6%. In Atlanta, Georgia, the blue line, we went from 8% to 6.8%. Jacksonville, the teal line, 7.6% to 6.3%. Then the story also holds for Vegas in green, Phoenix in purple, and Boise, Idaho in orange. In all of these markets, investors are getting more and more squeeze on the level of cash flow that they are getting from their real estate housing investment. And as these cash flow yields for these investors continue to trend down, that means that more of the future return expectation comes from future appreciation. And that's the key thing to think about, is that any investor buying in a hot market today is not getting cash flow out the door. They will need appreciation into the future to make their investment make sense. And that's why as appreciation starts to turn into depreciation as the housing market occurs, prices start going down, you're going to see investors start to rush to the door in these declining yield Sunbelt markets, because so much of their return expectation in buying today was based off future price growth. And once that future price growth doesn't happen and turns into a price decline, all of a sudden the calculus changes completely. And all of the stimulative demand that investors had during the housing market bubble turns into contractionary demand during the crash and makes the crash even worse. And so this is the silver lining for all of you guys here who are frustrated by this investor demand in the housing market, is that it is not long term, especially with the super low cash flow yields today and the fact that we now seem to be in a rising interest rate environment. A lot of these investors are going to feel pressured to sell. And when they do, who are they going to sell to? Locals in these markets are priced out. Prices have gone way up above wages. Renters cannot afford the down payments. And when investors can't sell to themselves anymore, they're going to have to cut prices. And that's going to make the crash even worse. And I really want to set the record straight here for you folks, because I see a lot of misinformation, misguided thinking about this. A lot of people seem to think that investors coming to the housing market means that prices can't and won't go down. They think that the presence of a Zillow or mom and pop investors paying cash means that somehow the market's going to continue to go up in the long run. It's the exact opposite. The more people that own a home who don't live in the home means that there's more downside for the housing market. If someone lives in the home, they're not going to rush to sell when values go down. If someone has the home purely as an investment, they will rush to sell when values go down, particularly when cash flow yields are low. Lastly, I want to make one point about who these investors are who are buying homes. Yes, it is a fact that Zillow and a lot of other iBuyers, such as Opendoor, are buying a lot of homes in cash, perpetuating the bubble. This is something that I've talked about in multiple videos in the past. I would encourage you to check them out when you have some time in the video history. However, we cannot forget that the small-time mom and pop investor is still by far the largest source of investor demand in America. Over 50% of all investor purchases, according to data from CoreLogic, are from small-time mom and pop investors who own less than 10 homes. Super important that you remember that. It's not just the big institutional players, it's also the small-time mom and pop investors. And in some way, these entities are kind of working together, buying and selling homes to each other to perpetuate the bubble. Both of them are going to be left in the lurch and are going to experience huge losses, especially if interest rates continue to rise over the next 6 to 12 months. And so if you guys enjoyed this content and you want to see more of it, I request that you do 3 things. This would be a big help to me if you do these 3 things. The first is hit the like button if you haven't already. When you hit the like button, it gets me more exposure on YouTube, allows me to produce more of this content in the future. Make sure you're also a subscriber. I come out with 3 of these data-driven videos per week, and now as the housing market continues to turn, I'm going to be updating you guys on what the real-time data is saying market by market each week. You're not going to want to miss it, so be a subscriber. Also think about joining the channel as a sponsor member. The cost is $5 a month. You help this channel financially, but you also get some really cool perks. There's an exclusive members-only community board where you can actually have an input into the future videos I do on this channel. Additionally, there's a members-only newsletter, which the second issue comes out next Friday, a members-only newsletter which breaks down all of the data on the U.S. housing market, includes my picks on markets to buy in, markets to avoid. So if you want to be a part of that, hit the join button. All right, everyone, I hope you enjoyed this video. Until next time, this is Nick from Reventure Consulting signing off.